Hey guys, so today we're going to be looking at the scenario we have here and answering a few questions. So basically, an article in a major newspaper reported that Moody's Investor Service, which is a bond rating agency, cut its rating on company X's bonds from a rating of A3 to a rating of A2. So here are the questions we're going to be answering. What is Moody's top bond rating? Under what circumstances would bond rating agencies be likely to cut the rating on a company's bonds? And what will be the result of the rating cut for the interest rate of company X, for the interest rate that company X will have to pay when it sells new bonds? So let's first go over the rating system. What Moody's bond system does, it tells us that what the risk of holding a bond is. So basically, these ratings help determine the interest bond issuer must pay in order to attract purchasers. And the ratings that we have are on the left, going from the best rating to the worst, specifically for Moody's rating system. We have AAA all the way down to C, AAA being the top rating and C being the lowest rating here. And we can see from our scenario earlier that we have Moody's Investor Service cutting its rating on company X's bonds from our top rating to our second best rating. Basically, we want to know why bond rating agencies would be likely to cut the rating of the company's bond in the first place. And the simplest way to put this would basically be that they would do this to signify higher risk for the person or investor who wants to purchase said bond. They put the risk rating, when they decrease the risk rating, it just means that these bonds are a bit riskier to purchase than they were before. And we want to know what would be the result of this rating for the interest rate that company X would have to pay. And as we showed earlier, or said earlier, these ratings basically help determine the interest that a bond issuer must pay in order to attract purchasers. And in this case, our bond issuer is company X. And basically, company X would have to offer a higher interest rate on new bonds issued with this new rating of 2 as the rate had gone. Basically, this describes a risk premium. And risk premium, the definition is a form of compensation for investors, buyers of the securities, or a form of compensation for investors and buyers who are taking in this extra risk by buying these assets. So basically, the increased interest would just be a form of risk premium, as the buyers of these bonds would be taking on more risks now that the rating has decreased from AAA to AA, or A3 to A2. But yeah, that has answered all our questions, so thanks guys.